Welcome back to the deep dive. Today, we're diving into a topic that I think is on a lot of people's minds, and that is tax-deferred retirement accounts.
Yeah.
Things like 401ks and IRAs.
Right.
We've got a whole stack of research here, and we really want to help people navigate this because it can be a little bit tricky to make sure you're really maximizing your retirement savings. And what's interesting is I always thought these accounts were pretty straightforward.
Yeah.
Like you put the money in, you get a tax break now, and you pay taxes later.
Yeah.
But the research revealed some surprising things. Like, for example, have you ever considered that even though conventional wisdom says that you'll be in a lower tax bracket during retirement, it might actually be higher?
Yeah. That's a real possibility.
Oh, wow.
And a common misconception that we see.
Okay, so let's start with the basics.
Sure.
Most people understand that with tax-deferred accounts, you get the tax break, now you pay the taxes later. Seems like a good deal, especially if your employer's offering a match.
Yeah.
What's the catch?
Well, the catch is what I like to call those vanishing deductions.
Vanishing deductions.
Yeah, so think about all the deductions you claim now.
Okay.
You've got mortgage interest, you've got child tax credits, you've got, even your 401k contributions.
Yeah.
A lot of those go away in retirement.
Right.
So even if your overall income is lower, your taxable income, because you have less deductions, could be higher.
I see what you mean. So you could end up in a higher tax bracket than you were when you were working?
Absolutely.
Even with a lower income?
Yeah.
That's definitely not what most people expect.
No, not at all. And this is where things get even trickier when we start talking about required minimum distributions, or RMDs.
Oh, yeah.
Which kick in at age 70 and a half.
Okay.
And essentially, the IRS is saying, time to pay up.
Right.
We've let you defer this for long enough.
Okay.
Now you have to start taking this money out.
Okay. So I've heard of RMDs, but honestly, they've always seemed a bit confusing.
Right.
What happens if you don't take them?
Well, there's a pretty hefty penalty.
50%.
On the amount that you were supposed to withdraw.
Wow.
Plus, you still have to pay the income tax on that.
Ouch, that's a big hit.
Yeah.
So you're basically penalized for not withdrawing enough.
Correct.
But I also remember from the research that withdrawing too much can also be a problem.
That's right.
Something about Social Security benefits being taxed.
That's right. That's the catch-22 of tax-deferred accounts. Withdraw too little.
You get penalized.
You get penalized, withdraw too much. And you could end up paying taxes on up to 85% of your Social Security benefits.
Okay, I'm starting to see why this deep dive was requested.
Right.
So how does withdrawing from my retirement account affect my Social Security benefits?
Well, it comes down to a calculation called provisional income.
Provisional income.
And basically what the IRS does is they take half of your Social Security benefits.
Okay.
And then they add any distributions that you take from your tax-deferred accounts, any taxable investment income that you have, and a few other sources. And based on that total, they look at your filing status.
Yeah.
Are you single, married, head of household, whatever. And then based on that, they determine how much of your Social Security is going to be taxed.
So the more I withdraw from my tax-deferred account, the higher my provisional income.
Correct.
And potentially the more of my Social Security benefits gets taxed.
That's right. And it can kind of be a slippery slope because if you have to withdraw more to cover those taxes, well, then
it just compounds.
It just compounds the problem. Exactly.
It seems like a real headache.
It can be.
It seems like there's a lot to consider when it comes to these tax-deferred accounts.
There is. And, we haven't even touched on, another common pitfall, which is underestimating how much you're going to need to withdraw to actually cover the taxes and still have your desired income.
That's right. There's that interesting math problem in the research. We'll have to break that down for our listener after we cover some other key points. But first, I'm curious, are there any situations where these tax-deferred accounts are actually a good idea?
Absolutely.
Okay.
It's all about finding the right balance. We'll talk about that next.
All right. Sounds good. We'll be right back.
It's all about finding the right balance.
Yeah.
For example, if your employer offers a matching contribution to your 401k, that's essentially free money.
Yeah, of course.
You definitely want to contribute enough to get that full match.
That makes sense, but wouldn't you be missing out on the tax deduction if you limited your contributions?
Well, yeah, you would.
Yeah.
But remember, the primary goal isn't to minimize taxes today.
Right.
It's about maximizing your retirement distributions tax efficiently,
Yeah.
especially later on when you might have less flexibility.
So the strategy is to kind of shift the tax burden to a time when you're better positioned to handle it. When
Exactly.
you have more deductions and disposable income during your working years and tax rates are potentially lower,
That's right.
that's a really interesting perspective. But what about those folks who are already maxing out their employer match?
Mhm.
Are there other scenarios where prioritizing tax-deferred contributions makes sense?
There certainly can be. For instance, if you expect to be in a lower tax bracket in retirement than you are now.
Right.
This could happen if you plan to downsize your home or move to a state with lower income taxes or have significantly lower expenses in retirement.
That makes sense. So it's really about analyzing your individual circumstances and making projections about your future tax situation.
Exactly. And here's something else to consider. Did you know that there are legal ways to access funds from your 401ks and IRAs in retirement
Interesting.
without paying any taxes at all?
Wait, what tax-free withdrawals from tax-deferred accounts? How's that possible?
It's all about strategically utilizing deductions.
Okay.
Let's say a married couple is planning to retire in 15 years.
Okay.
They're going to be eligible for the standard deduction, which will likely be higher than it is today due to inflation. So they could potentially withdraw up to the amount of the standard deduction each year from their tax-deferred accounts and pay zero taxes on it.
So they're essentially converting tax-deferred savings to tax-free income by utilizing that standard deduction.
Exactly.
That's a fantastic tip. It seems like there are more options than people realize when it comes to managing these accounts.
Absolutely. The key is to be proactive and plan ahead. And that's where this concept of, finding your ideal tax-deferred balance comes in.
Okay.
Ideally, you want your balances to be low enough that when you start taking those RMDs at 70.5, the distributions are equal to or less than your standard deduction in that year.
So if we look back at John and Susan from our research, they had $500,000 in their IRAs at age 70 and a half.
Right.
Their RMD was less than the standard deduction, so they wouldn't owe any taxes.
Correct.
That seems like a pretty good scenario.
It is. But if they had double that amount in their IRAs, their RMD would exceed their standard deduction, and they would have to pay taxes on the excess. Plus, as we discussed earlier, that large distribution could trigger taxes on their Social Security benefits.
It's amazing how even a small difference in your account balance can have such a big impact on your tax liability.
It certainly highlights the need for careful planning.
Yeah.
You want to hit that sweet spot where your RMDs are aligning with your standard deduction,
Right.
allowing you to access those funds tax-free.
Okay, so how do you figure out what that sweet spot is for your individual situation?
Well, that's where working with a qualified tax-free retirement specialist can be invaluable. They can help you project your future RMDs, estimate your standard deduction in retirement, and really determine, what your ideal balance should be, taking into account all the individual factors that we've discussed.
Sounds like a complex calculation.
It can be, which is why, professional guidance is often recommended.
Yeah, makes sense.
But even without a specialist, understanding these key concepts can empower you to make more informed decisions about your retirement savings.
Speaking of informed decisions, we still need to break down that math problem from the research. The one about calculating how much you need to withdraw to cover taxes and still have your desired income.
Yeah.
It really highlighted how easy it is to underestimate those withdrawals.
Absolutely.
Yeah.
That's a crucial point to cover, and we'll delve into it right after this.
Okay, so we're back and ready to tackle that math problem you mentioned.
Yeah.
It seemed like a pretty simple concept, but I have a feeling this could be eye-opening for some folks.
I think it will be. It really highlights how easy it is to kind of fall into a trap
Okay.
when you're thinking about, how much you need to withdraw from your retirement accounts.
Right.
Because remember, it's not just about replacing your income.
Yeah.
You also have to factor in those taxes.
Right, those pesky taxes.
Yeah, exactly.
So let's say you need $100,000 after tax to cover your expenses in retirement.
Okay.
And let's just assume, for simplicity's sake, your effective tax rate is 30%.
Mm-hmm.
How much do you actually need to withdraw from your accounts?
Well, most people would instinctively just add 30% to that $100,000
Okay.
and figure, okay, I need to withdraw $130,000.
That's exactly what I would have done.
Right, it seems logical.
Seems logical enough.
But here's the catch. If you're paying 30% in taxes,
yeah.
you're only keeping 70%.
Oh, right.
And 70% of $130,000 is only $91,000.
Wow. You're actually short
You're short.
$9,000.
Yeah, you're not going to be able to cover all your expenses.
I totally fell for that trap. So what's the correct way to calculate it?
So the correct way to calculate it is you take the amount you need after tax,
Okay.
which in our case is $100,000,
Mm-hmm.
and you divide that by 1 minus your tax rate,
Yeah.
which is 0.3 0 or 30%.
So it's $100,000 divided by zero point 0.7.
Exactly.
Okay.
And that comes out to $142,857.
Wow, that's a big difference
Big difference.
from the 130,000 that most people would probably calculate.
Right. And over time, that little miscalculation
Yeah,
can really add up.
it could really deplete your savings much faster than you expect. Okay, so we've covered a lot of potential pitfalls here, but what happens if someone listening realizes that their tax-deferred balances are already higher than that ideal amount that we talked about?
Right.
What can they do?
Well, that's where the concept of shifting comes in. You can strategically reposition funds from your tax-deferred accounts to other types of accounts, like tax-free accounts, to optimize your tax situation.
So you're talking about moving money from accounts where you defer taxes to accounts where you never have to pay taxes on the earnings.
Exactly, and this can be especially beneficial if you anticipate being in a higher tax bracket in retirement, or if you want to minimize the impact of those RMDs on your Social Security benefits.
That makes a lot of sense. But shifting sounds kind of complicated. Where should someone even begin?
It's definitely a complex process, and one that should be done with the guidance of a qualified tax professional.
Okay.
They can really help you analyze your individual circumstances and determine the most appropriate strategies
Right.
for your situation.
This deep dive has been packed with valuable information. Before we wrap up, is there anything else our listeners should keep in mind when it comes to these tax-deferred retirement accounts?
Just remember that, these accounts can be powerful tools for retirement planning, but it's crucial to approach them strategically.
Mm-hmm.
Understand the potential pitfalls, consider your individual circumstances, and don't be afraid to seek professional guidance when needed.
Excellent advice. And for our listener, we'd like to leave you with a final thought to ponder. Could diversifying your retirement savings beyond just tax-deferred accounts, perhaps by exploring tax-free options, be a smart strategy to minimize your tax burden and really maximize that retirement income? That's something to consider as you continue your retirement planning journey. Thanks for joining us on the Deep Dive.